Good morning, everyone. Welcome to this RM2 webinar on 3 reasons why EOTs are still performing and being set up in very good numbers despite the current economic uncertainties. My name is Nigel Mason. I'm one of the directors of RM2. And we are ourselves EOT owned and have been since early last year. I used to be the majority shareholder of RM2, so I'm a first-hand user of the EOT structure, and certainly from my perspective, as someone who is looking for an independent solution for RM2's future, the EOT worked extremely well and is working extremely well. Obviously, my colleagues ought to be the judge of that as well. But it just means that we have lived and breathed the structure for the last 20 months, and we can vouch for it. We're not just doing it because we felt we shouldn't be hypocritical. We did it because it was the logical solution for a business like RM2. So I'm going to speak for about 20 minutes. I'll leave a bit of time for questions at the end, and a recording of the webinar will be available on both our website and on our YouTube channel. That might take a couple of days to organize. So my marketing manager came to me a few weeks ago and said, could you do a webinar on the reasons why EOTs are performing well? And I said, yeah, I'd be delighted to. She said, it's got to be 3 reasons. It's got to be, the rule of 3. I said, well, that might be a challenge because I can think of lots more reasons than 3 why EOTs are booming. But nevertheless, I saw the wisdom of her advice, and I have kind of condensed my many reasons into 3 broad categories. And I might slip in a couple of additional reasons subliminally, but basically these are the 3 broad reasons in my view. And we ought to start with some data to back up my claim that EOTs are still being set up in good numbers compared to other types of private company transactions. So if we look at the data that is produced regularly by the accounting firm BDO, they do something called a private company price index. This shows the number of private company deals, whether by trade sale or by private equity. And you'll see there was a big drop-off in the second quarter of this year. Total deal volumes fell by 57% to 250 in total. Down from 582 in quarter 1. Trade sale volumes fell from 506 to 214. So there's undoubtedly been a fall off in conventional exit routes for private companies. Whereas, and we have certainly experienced this, I know many other advisors have as well, the number of EOTs being established has held up very well. This data is from a survey of all EOTs that have been established. It's administered by RM2, but we rely on the input of many others. We are not saying that this is actually the complete list of EOTs. We can only identify those that are publicly identifiable, publicly declared. But the number so far in 2020 is 43, which holds up well compared to last year and the year before. Probably won't match 2019 as a full year, but I think based on current trends is likely to be at least as good, if not better, than 2018, and therefore we can, I think, forecast that 2020 is going to be the second best year for EOTs. So why is that? So I'm just going to slip in a couple of additional reasons before I get onto my three main reasons. So first of all, I think business owners have had thinking time during lockdown, and that might seem a bit trite, but we do experience every year in more normal years, and have done for many, many years, a flurry of interest and inquiries straight after New Year as a result of people having had thinking time over the year-end shutdown, which, might be 2 weeks. It's certainly not 5-6 months. So I think business owners have had that kind of time to reflect on long-term future, which they normally find very hard to carve out from a busy working schedule. And they've been willing to give up control of their business now, notwithstanding the economic uncertainty, in return for the clarity of an exit plan that involves colleagues on whom they depend for their wealth and their livelihood. So I do think there has been an element of solidarity in companies, business owners appreciating the value of their employees, and in some cases reflecting that in their ownership succession plans. I would also have to acknowledge that the rumours circulating about capital gains tax and the Chancellor's need to raise further tax revenue, and the possibility that capital gains tax rates will be aligned with income tax rates, and the recent curtailment of entrepreneurs' relief, these have all undoubtedly attracted interest to the EOT structure because, as we know, it's a tax-free exit solution for business owners. We don't want EOTs to be attractive just for that reason. We want EOTs to be attractive for all the right reasons to do with securing an independent, healthy, employee-owned business. But the purpose of the legislation in 2014 was to attract the attention of business owners by making a sale of a controlling stake tax-free, and we have seen interest as a result. So here are my three kind of composite reasons why EOTs are booming in uncertain times. The first is that, unlike any other kind of exit route, with an EOT, business owners can create a deal that works for them and for the company, and if they wish, and most do, stay closely involved in the running and leadership of the business. Secondly, as we'll see in more detail, good valuation outcomes can be achieved, notwithstanding the uncertainties that everyone is facing at the moment, and they can be achieved without putting a company under financial stress. And thirdly, as we have long known, thanks to academic research around the world, but in the UK and in the US especially, employee-owned firms have been shown to be resilient, especially during recessions, and have shown to be very good, solid, steady performers, and therefore an entirely appropriate structure for these times. So on to the first main reason, that business owners can create the deal that works for them and for the company. I've already mentioned, I'm going to go into quite a lot more detail on how valuations can be constructed that are good for the vendor, but also not harmful for the company, which is ultimately going to be the contributor of the profits to pay that valuation. And that's actually reason number 2 coming up. There's no opportunistic exploitation of a crisis, as some more aggressive trade buyers and private equity buyers might seek to benefit from. An EOT is a internally created buyer, friendly buyer, and there is no kind of exploitation of a vulnerable owner. No information needs to be shared externally, and there is minimal disruption compared to other types of exit route. The due diligence that the EOT buyer requires can be extremely light touch. I mean, one still needs to check and investigate various issues, not least ownership of shares, the existence of shareholder agreements, the existence of share schemes that might result in ownership changing just before a change of control, the existence of charges that previous lenders have registered. All these things are essential investigations, but compared to the very detailed investigation done by a trade buyer, it's much lighter touch. And similarly, the warranties and indemnities required from the seller are degrees less onerous. And at negotiations, to the extent that negotiations happen between trustees and vendors, need not be adversarial. It is the role of the advisor, usually representing the company and not the vendor, to craft a deal which is in the best interests of the company. And if that deal is also acceptable to the vendor, then an EOT deal is very likely to happen. And as a result, deal costs, transaction costs, are much lower than other types of exit route. There's very low execution risk. Once a decision has been made to do an EOT, the probability of it concluding is very high. Vendors do leave a lot of value on the table in the form of deferred consideration, but there are many ways in which vendors, as effectively lenders to the EOT, can be protected in a way which is compatible with the EOT legislation's requirement for EOT control. As for other stakeholders, such as suppliers, customers, or employees, there is very little change, and that's reassuring at a time when all businesses are worried about uncertainty. There's enough uncertainty without people having to cope with self-inflicted uncertainty as a result of changes of ownership. Low execution risk appears to be a repetition, so I obviously did that to try and get my quota of reasons up to a high number. And finally, the vendor can have continued involvement, if they wish, in the formal governance of the business, a form of protection, but also a form of, I think, positive continuity, which I will illustrate on this next slide. So here we've got a single vendor who is selling a controlling stake to EOT trustees and who enters into a tripartite share sale agreement with those EOT trustees and with the company. That seller, that vendor, can be a trustee of the EOT, but in that capacity, of course, must always act in the best interests of the beneficiaries and must be outnumbered by people unconnected to the vendor, so that there has been a genuine transfer of control. There's no reason why the vendor can't also remain, if they wish and if the company wishes, as a director of the operating company. Again, it's a positive aspect of continuity, which, provided there is also a proper succession plan in place, should be welcomed. And then other protections for the seller, as well as those contained in the share sale agreement, include the provisions in the loan agreement to the EOT, which will provide similar but not as draconian set of protections as a bank would typically require. The vendor can take a charge over the company's assets, though not over the EOT assets, and that charge can be supplemented with a guarantee from the company. So there are many ways in which a vendor can remain protected in the event of plans not coming to fruition in a way which is completely compatible with transfer of control and with the EOT legislation. Let me now go on to reason number 2, and I want to illustrate how, despite uncertainties around some companies' trading performance, it's possible to come up with a valuation which can work for both the company and the vendor. So let's take a hypothetical company with EBITDA of £1 million, and let's assume that a trade buyer would be willing to offer a multiple of 6 times EBITDA. Usually a trade buyer would offer more than an EOT buyer would be willing to offer, because the trade buyer can extract synergies, cost savings, revenue enhancing arrangements by merging one operation with another. That access to synergies is not available to a standalone buyer like an EOT. And if we add on free cash, and assuming that free cash has been carefully tested to make sure that it truly is surplus to operating requirements, notwithstanding the uncertainty about future short-term trading projections, then that's going to lead to an equity value for the EOT of 7 million and for the trade sale of 7.5 million. Now, how is that value delivered? Well, as well as the purchase price that we've just calculated for the EOT, we're going to need to provide for transaction costs, and because we're going to be raising some finance from a bank, we need to provide for the bank's fees as well as our own internal fees, and the stamp duty payable at 0.5% of the purchase price. So we've put in a provision of 175,000 for total transaction costs, and that is made up of free cash on the balance sheet, senior bank debt, which is set at 2 times EBITDA, and then a balancing item of junior vendor debt, subordinated debt if you like, to make up the £7.175 million. And the way that is deployed is that the total amount of cash that is raised for the transaction, that's the free cash on the balance sheet and the senior bank debt, minus the transaction costs, gives the vendor upfront cash of £3.325 million, which is tax-free. And then over subsequent years, repayments of junior debt or subordinated debt of 3.675 million, also tax-free because they represent installments of deferred consideration, and justifiable interest on the junior debt, which over the term of the junior debt could easily add up to something like £700,000. That's income taxable, probably, in the hands of the vendor. Compare that to the vendor's proceeds with a trade sale. Well, we did acknowledge that a trade sale was likely to deliver a higher overall value, but a significant proportion of that is most likely to be held back or made contingent in the form of an earnout. And typically earnouts might be of the order of 20% of enterprise value. And so the amount of upfront cash which the vendor might get from a trade sale is significantly higher than for an EOT. But remember, that's likely to be taxable. The marginal rate of 20% under current tax rates could be higher if CGT is reformed. Apart from the first £1 million, which could be at the lower 10% rate. So I think an EOT puts in a very strong showing compared to a trade sale, notwithstanding the fact that a trade sale can usually deliver a higher EBITDA multiple. And then I think some of the clever stuff around EOT valuations is really coming into its own in this current economic kind of uncertain time. So the first thing to say is that company contributions to an EOT, which is what the EOT uses to make its payments to selling shareholders, have to be covered by distributable profits. That's a matter of company law. They may not be distributions like dividends, but they're very similar to distributions, and it would be an unlawful reduction in capital if such contributions were made other than from distributable reserves. So there's a natural kind of moderating impact on the amount of company money which can be paid to an EOT, notwithstanding the terms of the original deal. In a lot of our own projects, we go further and we say that it would be prudent for the company to limit the amount it contributes to the EOT to a percentage of free cash flow each period. And free cash flow means after having allowed for working capital, tax, capital expenditure. So making sure that the company is not going to be denuded of liquidity because of the deal that might have been struck at a time of uncertainty. And then in return for that cap on company contributions, it's reasonable to give the vendor the reassurance that contributions will at least be, let's say, Y% of free cash flow. So you've got a kind of a cap and a collar on the amount of free cash flow which an EOT can expect to receive, although these are voluntary contributions, in order to pay the selling shareholders. And then the final feature, which it is now a feature of most, if not all, RM2 deals, and it's one which is very protective for the company, and that is to impose a long stop date on the vendor loans. We call it a sunset clause. And the way it works is that if after a number of years where that number is set, according to the particular circumstances of the case, if after that number of years there is still vendor debt outstanding, then any outstanding balance is written off. It's a way of ensuring the EOT trustees are not in very long-term indebtedness to vendors. And if that were the case, it would mean that, admittedly with the benefit of hindsight, a valuation had been arguably overcooked at the outset. So we think that this sort of structure allows a company to be sold, even in the current uncertain time, for a fair value for the vendor and in a way which protects the company and the EOT trustee from having overpaid or from being in a position of financial duress. And it seems to be working very well. Finally, reason number 3, of all the structures available for business ownership, employee ownership is one of the most suitable for current times. It is all about everyone being aligned with the same interest to make the business succeed. And there are lots of studies which show a lot of positive benefits of the employee ownership structure. For a start, employee owners seem to be more engaged. They're more likely to be satisfied with their company than non-employee owners. They're more likely to believe their company is a good place to work. So they're positive feelings that employee owners have towards their business, from which then follows some behavioral benefit, behavioral change. Employee owners have been shown to be less likely to take unplanned absences, which is usually a proxy for low morale and motivation. Employee owners are more likely to provide discretionary effort, and employee owners feel more loyal and are much less likely to be looking for another job. So these start to translate into tangible business benefits, which ultimately are going to add to company performance improvements. And a whole raft of studies, especially from America, but increasingly from the UK, and anecdotal evidence from things such as the top 50 list of the largest employee-owned companies that we compile, are showing that employee-owned firms are more sustainable and resilient through economic cycles, that they actually generate good growth, especially in sales and employment, and especially where they have well-developed systems for employee involvement and participation, and employee-owned firms have higher productivity growth. So it's a good structure for current times. And as I said at the beginning, I do think there is an element of appreciation and realization that we're all in this together, and that a position in which a single owner expects others to take the pain so that they can salvage an asset is probably much less tenable these days. So I do think employee ownership is being shown to be the right structure for these times. That's all I'm going to do on the presentation. I've gone slightly over 20 minutes. I'm going to see if we've got any questions. Yes, we've got a few questions. First question, have you heard anything about the CGT exemption for EOTs being changed as part of the new capital gains tax review? Well, I mean, there are rumours about CGT. The Chancellor has postponed the budget from November to sometime next spring. I mean, it's easy to speculate, but my own personal prediction is that EOTs are still in their infancy and are not really a top priority target for tax raising. And therefore, if there is a change to CGT, it is likely to be to entrepreneurs relief and to capital gains tax rates generally. The effect of which it's true will show EOTs in an even more favorable light, and that won't always be a good thing for EOTs. We may be attracting users who are not really motivated by the underlying philosophy, but just by the tax saving. I've got a question. Does RM2 have any evidence of the EOT model being exploited to permit structures and or cultures not in the spirit of employee ownership? The short answer is no. However, I would fully acknowledge that some companies are much more employee ownership ready and employee ownership aware than others. So we do occasionally, quite commonly, receive inquiries from traditional founder-owned private companies who completely understand the EOT structure, but might not yet be in a position to win awards at the EOA conference. And my belief is that these things can take a long time to change, and changing the ownership with all the guarantees that the EOT structure provides for all employee inclusive ownership is a big step in the right direction. And if it then takes years for a culture to change, well, that is something which may need to happen. I think changing company culture, as we would all acknowledge, is a very open-ended, can be a very long-term process. What are the minimum transaction fees for a small company? Well, you need to test the market with advisors to find the answer to that question. It is a change of control, and if I were an owner of a business, as I was until quite recently, I would want to make sure that that giving up of control and value and equity is being done in a way which I feel comfortable with and where I feel protected, and accepting that promises had to be made by me to the new owner, in this case the EOT. I need to be sure that those promises are true and can be met and delivered. So, the usual steps that are taken in any change of control transaction are required. And I would also emphasize the value of financial planning. We've seen elsewhere EOT deals done with very little thought given to how the value and the deferred consideration is going to be structured. And I worry that this leaves companies in a much more vulnerable position than if careful planning had gone into the structuring of the vendor loans and the repayment schedule for deferred consideration. So it's a long answer, but I'm saying don't cut corners if you're selling your company, and because it will lead to all sorts of risk. Question, who can act as trustees? Well, the answer is any fit, proper, competent person. There is no prescription in the legislation for who can act as an EOT trustee. I did mention that the seller can be a trustee. In fact, if you have multiple sellers, you can have multiple seller trustees, but they would need to be outnumbered by completely independent people, whether that's internal people from employees or external independent people. But you can also have a professional trustee, someone whose job it is to act as trustee, which we have seen in a small number of cases. Is there a single reform you would advocate to the EOT regulation to increase its effectiveness? Yes, I've got one favorite request, and I don't think this would necessarily boost the popularity of EOTs, because I think we have a very good balanced regime at the moment to encourage business owners to look at EOTs. I'm very happy letting sleeping dogs lie on that side of the equation. But what I worry about is the difficulty that companies face in conveying value to employees once vendor loans have been repaid. It's very, very cumbersome for an EOT-owned company to share capital wealth with its employees. And as a result, many EOT companies are going to remain entirely trust-owned. Now, from a governance and stability point of view, that's extremely positive, but I worry about pressure building up for employees to see some more tangible value from employee ownership. After all, employee ownership is about wealth as well as participation. So I would like to see the idea of an EOT being combined with the idea of a share incentive plan. And if I could plug a paper that I wrote for the think tank Ownership at Work, which is called Equity for All, which hopefully makes a longer case and a more compelling case than I've just made now. I'm going to only take one more question because we're running out of time. I've heard of some concerns that the contributions from the company to the EOT could be taxable dividend in the hands of the trustees. Is that just overthinking it, or is it a legitimate concern? It's a kind of plausible concern. And it's plausible enough for us to have taken our own second and third opinions on this question from leading counsel. There are one or two steps that can be taken to make sure that treatment is much less likely to happen. For example, we commonly put a dividend waiver in the EOT trust deed. And the way in which contributions are structured can be made to look significantly different from dividends. And I'm not aware of any challenge having been made. I do think it's an area where the legislation could be clarified to put beyond doubt that contributions to an EOT are not going to be income taxable in the hands of the trustees. So it's an area of uncertainty which, as far as I'm aware, has not been acted on by HMRC, and therefore it's legitimate but not significant. I'm afraid I have run out of time. I've gone 4 minutes over, and I'm absolutely duty bound to not go over too far. So what I will commit to doing is, as well as posting the video, I will be answering all the questions in a Word document, which we'll post on our website in the next few days, because there are some really good ones. So thank you very much for your questions. Thank you very much for taking the time, and stay safe, and I hope everything stays good for your business. Goodbye.